talking about the opportunities and advantages of public and non-publicly traded real estate. We'll use the term REITs frequently tonight. A REIT is just an acronym, REIT, which stands for Real Estate Investment Trusts or Trust. So forgive me when you hear REIT mentioned over and over again. It's not a vegetable, it's a real estate investment trust, REIT. Why now? Why are we talking about this now? Well, if it wasn't lost on you already, traditional stock and bonds this year are vastly underwater. Not all, and we feel we've done a decent job at finding some of those resilient sectors of the market like utilities and healthcare that have not been hard hit, but the average stock is down considerably this year. And more importantly, bonds or fixed income, which is kind of Ryan's expertise, bonds and fixed income are traditional risk reducers. They are traditional risk buffers to a downturn in equity prices. But higher interest rates and inflation is, at least temporarily, the kryptonite for bonds. And we're seeing an inflationary cycle, or at least the perception of an inflationary cycle for the first time since the late 70s. And so bonds are devaluing again temporarily because of the threat of higher interest rates. So this inflationary cycle that we're in, real or perceived, or I should say short-lived or chronic, it's hurting both traditional stock and bond positions in your portfolio. So naturally, those of us that live in semi-affluent areas who have watched their homes appreciate 15, 20, 25%, at least on paper, while traditional stocks and bonds have gone down in value, are wondering, why is not all my money in real estate? What else could I be doing by employing real estate investments into my net worth, into my portfolios, into my balance sheet? And it's a good question, because true diversification is finding low correlation to the majority of your assets. So if the majority of your assets are in 401ks and even the best of intentioned stock and bond portfolios, but they're all being hit by the same influences and real estate is going up in value, then that is a true diversifier. So this is why we're talking about real estate now, because A, we're in an inflationary cycle, and real estate historically tends to perform better in periods of inflation. Number two, stocks and bonds are highly volatile in the short run, and there are a lot of investors who are becoming nervous and unsettled by the reaction that stocks and bonds have had this year. And then the third reason why we're talking about it, and this is kind of one of these things that everybody knows about, but they don't really give proper consideration to. Bonds, most forms of bonds, are correlated to interest rates. So interest rates have come down over 30 years. And as of a couple of years ago, interest rates in the US were only 0.5%. So the interest rate on bonds has come way down. Eventually, it'll go back up. But for now, the rate of return on these risk-free assets is very low, even now. The cash flow that you get from real estate, often defined as cap rates. So cap rates are to real estate what a dividend yield is to a bond. Cap rates are basically the amount of income you get from your real estate property, less the expenses to carry it, divided by the value of that property. And most cap rates for high quality real estate are 6, 7%, 8% in some higher quality cases. So cap rates are not correlated to interest rates. They're correlated to the cost of living and to demand. So, if you're going to rent an apartment in a multifamily apartment building and the rent is $1,600 a month, that's not related to interest rates. So cap rates on real estate or cash distribution dividend yields, in effect, on real estate are more stable. And so people want to get a good dividend, good interest rate, a good distribution on their income investments. Real estate is attractive in that area. Okay, so, the conversation we're having now with all the folks that are calling in to say, why not more real estate? Then the debate or the question is, but is it better? Is real estate better? Well, the first answer, which may be surprising, is the reality is the academic study proved that the long-term rates of return on equities are almost identical to the long-term rates of return in real estate, 7 to 8%. But there's a difference in the way they behave, and it's the difference in behavior that investors are after right now when they feel compelled to put more money into real estate. But let's step back from that. Buying an operating company, when you buy a stock, when you buy Johnson & Johnson shares, you're buying an operating company that's growing its business, growing the amount of products and services they offer, and growing their earnings as an arc over time. So if we could fast forward to 2030 and look at the annual earnings per share of Johnson & Johnson, it should be expected to be significantly higher than it is today. So when you buy shares of J&J, you're buying into the higher arc of their earnings as an operating company. That's how your stock price grows. Real estate is a physical asset. It's not an operating company. It's a building with windows and boards and offices and chairs. So why would it change in value? Well, it changes because the physical asset is worth more or less based on supply and demand. So owning stocks is an operating company, but that operating company, its earnings can be valued differently every second of the day as influences come into the market to affect how people feel about those prices. A physical asset isn't valued every day. There's not a sign up there that tells you what its value is worth minute to minute. There's no exchange, public exchange for real estate that shows you how much it's going up or down. So the rate of return in high quality stocks and real estate is actually quite similar. The difference is they behave differently. One is an operating company traded on a stock exchange that can have great volatility in what people think it's worth. And real estate is a physical asset that kind of stays there until someone appraises it differently. So when people are looking at inflation and whether real estate is a better protection against inflation, it's really the same entity. People like real estate because cap rates can increase. If prices of things go up, real estate owners can raise their rents, and that offers protection against inflation and maintains the value of that property. But so too stocks. Johnson & Johnson is out there every day pushing to grow their earnings, which they will over time. And I often wonder, what would it look like if real estate did have a daily stock exchange like entity? Then people would see, at the peak of the pandemic, we were putting some siding on our house in Guilford, and we had one of those big, what do you call those big garbage bins that get hauled away? Dumpster, thank you. So I had a couple people come up to me and ask me if I was moving because they saw a dumpster in front of my house. And I went on Zillow and my house was like worth $750. And since that's died down and interest rates have gone up, I went on Zillow the other day and it said it was worth 650. It's like, wow, how did I take $100,000 haircut on my house? Obviously, that's not real. But imagine if real estate did have a daily exchange, people wouldn't see what they believe to be this rock of Gibraltar, that it just holds its value daily. The reality is real estate and equities have different cycles. They have different influences, and there's value to both. If you're going to be a true diversifier, you want to have equal presence with real estate and equities, because one will flourish when the other is not. One will flourish while the other is not. So probably when growth stocks resume their upward trajectory, you'll probably see real estate prices cool off and vice versa. The other problem with real estate, and we're going to touch on that, is that it has a high ticket price. So it's hard to use real estate as a traditional portfolio diversifier. It would be lovely if you could just say, I want to put 30% of my IRA in a fractional ownership of my house or a vacation property. But it's not easy to do that, particularly if that vacation property is worth 800,000 and your IRA is worth 6. So that's one of the problems with real estate, whereas you could buy a share of Johnson & Johnson for $180. So the fractional ownership of equities tends to make that sort of a benefit. But the other commonality between real estate and equities is that it's just like stocks, it depends on the property. There is no one unanimous answer. If you find a great property, it's a great value no matter what else is going on around you. Just as if you find a great stock in a bad neighborhood and it's a growing company, you'll benefit from it. And just because we're into disclosure and fairness, we feel it's kind of self-evident. I don't know why my house has gone up so much recently, but I don't feel it's necessarily sustainable in the short run. Most real estate is debt financed. I have a mortgage. Most commercial real estate owners do it on debt, borrow from appreciation, buy another building on debt. So most real estate is debt financed, and higher rates, as we're experiencing now, can cause immediate depreciation, just as it does in the stock market. The other subtle influence here, which is kind of annoying, is that institutional private equity and hedge fund buying is causing certain segments of the real estate market to really go up at a much faster rate than it would have ordinarily. So you're getting certain areas of the country that have crowding out by institutional hedge funds, to the point where some communities are trying to pass laws to ban certain levels of purchases of single family homes by institutional money managers, because it cuts out, the middle income or suburban family from being able to afford the house. Higher financing of real estate causes lower long-term return on investment, just like it does in the stock market. And of course, supply is low right now. So as we get a generational turnover by folks like my parents, and the market starts to get more supply, that might pierce the bubble a little bit. So, real estate right now is fantastic because it's going up in value while our liquid portfolios are declining. But there is a bubble there, and we have to be mindful of it. So these are all the introductory facets of opportunities and advantages of real estate. But don't get me wrong, we are not down on real estate because we spend most of our time dealing with traditional public securities. We're very high on it. We're all beneficiaries of it. We urge our clients that are underinvested in real estate not to be. But everything has its place. It's all about portion sizes. It's all about balance and diversification. So we're now going to go into some of the actual recommendations for real estate. So, and just think of these as 5 different levels. The first level, the most accessible, the security that most of our clients have in every portfolio we manage are publicly traded real estate investment trusts, publicly traded REITs. So what is a REIT? A REIT is a tax advantaged, IRS advantaged entity that says if you own and manage a bunch of real estate, if you pay out a minimum of 90% of your net cash flow, your net income from your properties, if you pay out a minimum of 90% to your shareholders, you will not have to pay corporate tax on that cash flow. This is why dividends on REITs are so high, because these real estate companies are trying to meet that 90% mandate. So that's publicly traded REITs. Publicly traded real estate investment trusts are traded on the New York Stock Exchange every day. So they're liquid, they're easy to buy and sell, but they're more volatile because the market changes its opinion of that real estate company's future earnings every day based on what they hear about Kuwait, what they hear about inflation, what they hear about recession. So they're more volatile, but it's liquid. It's easy to get in and out. There is growth potential in publicly traded REITs because, again, it's not a building. It's not a parking lot. It's not a public storage unit. It's not a hospital. It's an operating company that owns and operates real estate. And as they expand, buy more properties, get into more areas, the shares of those companies can grow over time. They're available in small increments. So if you had a $100,000 IRA and you wanted to put $15,000, 15% of that into real estate trusts, you could do that because you could buy fractional shares of these publicly traded real estate companies. They have high dividend yields, which I will show you in a minute. And the entire real estate investment trust industry has evolved. It's very much evolved. When I first started in 1983, real estate trusts were basically manufacturing properties and office buildings. Now you've got a whole range of these different forms of real estate investment trusts. And we're going to show you some of these. So this is the National Association of Real Estate Investment Trusts, and they produce information on REITs. So number one, I'm just going to show you the different types of real estate trusts that are out there. And Dave, tell me if the font size is too small. So on the left side here, you see there are industrial real estate trusts, office real estate trusts, retail, shopping centers, regional malls, residential, apartments, manufactured homes, single family homes. You have lodging and resorts. You have healthcare real estate, which is phenomenal in my view. It's a big theme for us. This would be REITs that own and operate medical office buildings, research facilities like in the biotech industry around Cambridge, Mass. Academic medical buildings like at the University of North Carolina campus, and senior assisted living houses, continuum care communities. That's healthcare. Self-storage would be things like public storage, U-Haul. You now have real estate investment trusts in timber, like Weyerhaeuser. The lumber company Weyerhaeuser is a real estate investment trust. So you get a big dividend and you have exposure to timber. Infrastructure. So we have a real estate trust that we just love, and it's very involved in the infrastructure. It's called Hannon Armstrong. This is not a recommendation, but just to give you an example, they're based in Annapolis, and their business is to finance and retrofit traditional manufacturing plants with newer energy efficient systems to lower their carbon footprint. And it's just taking off. Government projects, educational projects, private projects. That's a real estate investment trust based in infrastructure. Data centers like computer servers and specialty things like American Tower, which is a company that owns and operates the properties that host all the 5G cell towers. That is a real estate investment trust. So these are all the different types of real estate that you could add to their portfolio. And you see in this column here, the dividend yields are much higher than equities. So you've got 3-4% dividend yields in shopping centers. You could find, 2-3% yields in self-storage. A lot of these yields are low right now because, there we go. Sorry. 4% in healthcare REITs, 5% in diversified, 4.7 in freestanding retail. They're really nice yields. They were a lot higher before prices went up. So as the prices are coming down in real estate trusts now, the yields will get even better. So that's a little bit about the different types of REITs that can be found. And the last thing I'll say about the publicly traded REITs is that their returns are competitive to traditional common stocks. So we're going to show you a chart of what that looks like. This is a chart that was provided by the National Association of Real Estate Investment Trusts and Slick Charts. So on the left here is the time period. In the middle column is the total return of US blue chip stocks as expressed by the S&P 500. Oops. And on the far right is the aggregate return of all real estate investment trusts that are publicly traded. So what do you see? This year, it's kind of the same. The S&P 500 is down 18.3%. REITs are down 15.8%. That doesn't feel much better. Over the last 5 years, REITs have averaged 9%, whereas the S&P 500 has averaged a much higher 12.5%. Any idea of why that is? Any guesses from our guests as to why over the last 5 years, common stocks would be so much higher than real estate investment trusts? All right, the answer is that the S&P is cap weighted to Microsoft, Apple, Amazon, Netflix, Nvidia, all these high priced tech stocks that were the major winners in the capital markets over the last 5 years. And of course, real estate investment trusts have nothing to do with that. So they lagged a little bit to these mega tech stocks, but that now has been turned upside down. But the longer averages, over the last 10 years, the S&P has averaged 14, whereas real estate's 13.2. The last 20 years, real estate trusts have a double-digit advantage. Over the last 25 years, they're almost identical, 12%, 12%. But as you can see down here, I put a caution. Hope everybody sees that. And I stole a term from our research colleague, Steve Worth, who reminded me, yes, but for the last 30 years, we've been sailing downwind, meaning real estate should expect and stocks should be expected to have a great return when interest rates are falling year after year. It just inflates the value of assets. So what would it look like if real estate investment trusts had to perform in a higher interest rate market? Well, it wouldn't be as great. So we found it interesting that this chart also includes 1972 to 2001, where real estate trusters still have double-digit returns. So this isn't going to be this is not a forward-looking projection. Rates of return on real estate investment trusts and stocks will be lower in a higher interest rate environment. That is absolutely certain. But the comparative advantages between publicly traded real estate and stocks is very competitive. Now we're going to move on to a unique sector that a lot of folks don't know about: non-publicly traded REITs. So it's the same format, but rather than trading these real estate companies on a stock exchange, you have to invest directly with the managers. So when you buy a publicly traded REIT, you're turning the money over to the real estate management company and you're investing directly with that entity. They're illiquid. You can't just go in and sell them on any given day. There has to be a liquidity event. But the nice thing about non-publicly traded REITs is their asset values don't change every 3 seconds. So if you're in a real estate investment trust that owns multifamily housing in the Midwest or large box retailers like AutoZone, Amazon, Walmart, and you own those properties, they're not being valued every second on an exchange. They have to be appraised every couple of years. So when you own them, the value of your account stays very constant. And people take a lot of solace in knowing that their non-publicly traded REITs are holding their value in a period like 2022 when stock prices are melting down. So the illiquidity of non-publicly traded REITs is both a good and a bad facet of this style of investing. If you need to get your money out, you're going to have some difficulty, but while you own them, you get a much more quiet investment experience. They typically have 7 to 10 year holding periods. And the general thought by most non-publicly traded REITs is that they will sell their real estate book to a large institutional real estate owner like the Carlyle Group or Prudential Real Estate, and they'll sell that portfolio of assets for more than they bought it for, and that you would see some form of capital gain at the sale of the properties. They do require a high dollar commitment. Most of the time, you can't get into a non-publicly traded REIT for less than $25,000. They have less growth potential because they're not trying to, own the world. They just buy the buildings that they buy with the capitals that they raise, and they leave it at that. But they do claim that if the real estate appreciates and they keep their occupancies up, that they would be able to sell their book of business at a gain to an institutional buyer down the road. The key to non-publicly traded REITs is they typically have a distribution rate. I use the word dividend yield, but it's more accurate to say a distribution rate in the 5 to 6% range. So if you had a $100,000 investment, you're getting more than bonds, which pay 3%. It's not as much as owning a freestanding small office building where your cap rate might be 7.5, but you are getting a 5.5 to 6% dividend, and the value of that property will not devalue like bonds do, at least not on a daily basis. So you get a very stable, predictable return. If you're investing $100,000, you get $500 a month, which is 6%, and it comes like clockwork. And all of that is just the pass through of the rents that they bring in, and they have to pay 90% of that free cash flow out to you in the form of a distribution. So it's a wonderfully stable entity. And much like the publicly traded REITs, you can get non-publicly traded REITs in almost any sector: office buildings, manufacturing, Amazon fulfillment centers, public storage, mobile houses, modified houses, pretty much anything. There's a virtual shopping list. And now we get to the caution side. there are a lot of fees involved in non-publicly traded REITs. It's not nefarious, just that you have a lot of actors. So there are real estate acquisition people that get paid to find the properties. There's the real estate management company that gets a fee, and then they charge, a small asset fee for profit, and the rest goes to you in the form of a dividend. So, with these non-publicly traded REITs, there's a lot of due diligence involved. You got to drill down to get, the best deal for your money. All right, so this is a typical non-publicly traded REIT. Happens to be, you see that, Dave, Blackstone?
Yep.
All right, so it's run by Blackstone, which is the largest real estate owner in the country. At this time in 2018, they had $12 billion in assets spread out over 350 properties with an aggregate occupancy rate of 95%. And on their regular class of shares, their distribution rate to you as the investor, net of fees, is 5.85% paid out to you monthly. What are they invested in? Well, in this particular case, 56% of it is in multifamily properties, 31% in industrial, 11% in hospitality, and 2% in large anchored real estate. And they have a really nice geographical breakdown. So it's not all that critical, but it's mostly centered in the South, equally centered in the West. It's got 14% in the East, 10% in the Midwest. So, this is a typical REIT. You would put your money in, you'd get your 5.85% lockdown distribution yield. You wouldn't see any drama in the share price, but it's illiquid and you need to hold it until they have a liquidity event, which can be, 5 years down the line or 10 years down the line. So clearly it can't be invested with money that you need. That's non-publicly traded REITs. The next category is opportunity zone REITs. This is a really new and up and coming phenomenon product. The definition of an opportunity zone REIT, it's much like the non-publicly traded REITs. But in 2017, the government passed a law that gave tax advantages for real estate investment trusts that were developing properties in communities that were underserved and had excessive poverty. So the idea is that if a real estate development company goes into, the Red Hook area of Brooklyn or some depressed area of East St. Louis and develops these properties to improve their standard of living and the retail footprint, to make positive community change and create jobs for people in the area, the government offers tax advantages. So what are those tax advantages? Well, number one, you can defer capital gains on traditional investments that you sell with, as long as you put that money into the opportunity zone within 180 days. So why am I saying this? Somebody has a portfolio that has an excessive amount of money in Apple or Amazon or the like, and they want to diversify. They would like to reduce those tech positions, but they don't want to pay all the capital gains tax. So you could sell $200,000 of your tech stocks, create $100,000 capital gain, but defer that by investing the $200,000 into the opportunity zone real estate. The way it works is that you defer those capital gains out to 2027. So you're not having to pay that money for the next 5 years. And then if you hold the opportunity zone REIT for 10 years, then you will never pay any capital gains on the sale of the real estate assets if they sell for a gain. So deferring capital gains that allow you to diversify your portfolio, but also knowing you won't have capital gains on the REIT itself if it sold for more than you invested. So these are highly attractive investments right now for people who want real estate exposure, but they also want tax advantages. They don't come around every day. There are only certain neighborhoods that have qualified to be opportunity zone investments. And then the rest of it is the same as the other REITs. They're illiquid, which is good and bad. The good part is that you don't see your portfolio going up and down every second like the stock market. It takes high dollar commitment than buying publicly traded REITs, which you could get for as little as $100. There is promise of potential capital gains. That there's a little overhype by real estate real estate developers right now, thinking that these opportunity zone properties will experience huge appreciation as that real estate brings the standard of living up in those neighborhoods. So that's yet to be seen, because opportunity zone REITs have only been around since 2017. And of course, there are a lot of fees and you got to do your homework. But the people that have them are happy that they do, and there is some social benefit to opportunity zone REITs. The last variation on this theme is a hybrid between publicly traded REITs and their liquidity and their ease of use, and the non-publicly traded REITs. And they are called interval funds. So don't shortchange Wall Street to come up with a new product whenever the need arises. It's fintech is a big thing. So now we have real estate interval funds. They are defined as essentially, the same as non-publicly traded REITs, but they maintain a liquidity reserve that allows for people to, as it says here on the second bullet, you typically in real estate interval funds, you typically get the opportunity to redeem, to liquidate on a quarterly basis, but it's not guaranteed. And it depends on how many people are trying to liquidate. So oftentimes you'll just see a non-publicly traded REIT that sends out a notice saying, hey, starting June 1st, we'll take redemption requests of up to 5% of your position or something. And then everybody requests and they figure out how much money, how much cash they have to let people cash out. So it makes it a little bit more liquid. These real estate interval funds can be held at major custodians like Schwab and Fidelity. So you can have a real estate interval fund in your portfolio, in your IRA, and then you get some of the other benefits, which is these interval funds, they don't change their net asset value every day because they're not being appraised every day. So I owned a real estate interval fund for a long time. It didn't change a dime for like 4 quarters. And when they changed it, they upped it by 2 cents a share. So they're very stable, and they'll take some of the drama out of your portfolio. They also pay 5 to 6% distribution rates. So if you had a portfolio where you had 30% of your money in treasury bonds earning 2.5, showing some degree of volatility now with interest rates fluctuating, you could consider an interval fund, which would give you twice the dividend, 5 to 6%, and wouldn't vary in its valuation as much. You have other downsides, which are the liquidity issue. So these are called real estate interval funds. So what we've covered here, to summarize, we have publicly traded real estate investment trusts, non-publicly traded REITs, and then a third, opportunity zone REITs, and then a fourth genre, which is a hybrid. They're called real estate interval funds. These are all variations of professionally managed multi-property packaging of real estate designed to allow investors to get in with smaller amounts of money and take advantage of the positive attributes of real estate. What this does not cover is just the advantages of owning direct real estate. So we're going to finish with that. There are fewer notes on the subject because everybody understands the advantage of direct real estate if they own a home. Real estate this year is the new gold. It's the new inflation hedge. And with the pandemic and institutional money managers flooding the market with buying, it's made direct real estate look like the most brilliant investment of the last 4 decades. And it has been for this short period of time. But there's more to say on it. Number one, it's just, there is no, I don't think there's any individual rule of thumb. It's all about the property. Real estate could be in the dumps. Real estate could be way overpriced. If you find a great property that's devalued and cheap for whatever reason, because it's neglected or because it's in a neighborhood that hasn't come up to standards of its neighbors to the east and the west and the north, then, maybe it's a great opportunity. Maybe you just find an older woman who's widowed and just wants to downsize and doesn't need to sell their property at market rates. They know they bought it for 150. If they could sell it to you for 400, they consider that a huge accomplishment. They're not going to, push trying to get 5. So there are many reasons why you could find a good property in a hot or cold real estate market. And it's all about the cap rates. You should get, if you're going to venture out into direct property as an investment rather than a residence, you need to be getting 6 to 8% cap rates, meaning 6 to 8% return on rents. Because any less than that, you're just better off going to common stock and not having all the management hassles and all the carrying costs. But you can find that. We have a client who bought a nice house, a sort of a small Victorian house on the Madison, Connecticut Green. And he's got 4 separate businesses in there, a CPA, a family counselor, another family counselor, and I don't know, a consultant or a surveyor or something like that. And he gets a nice amount of rent, and it's very competitive with the long-term rates of the stock market. And he doesn't see the price bop around every second of the day. But direct real estate is hard to monetize. If the rents get disrupted for any reason, or you're in a situation where you need access to capital and your stock portfolio is highly appreciated, your IRAs are taxable as income. If you pull it out and you just want to get your hands on some of that real estate money, you can't just sell a couple shingles. You got to take a home equity line against it or sell it. So they're hard to monetize. Direct real estate is a large financial commitment. You know that. You don't need me to tell you that. And there are high carrying costs and high management responsibilities to being a landlord. However, what I'm going to close with is some interesting ways that you can participate in real estate and make it a little bit more affordable, so that if we were to have a private conversation and you were not flush with discretionary cash, if you sold a business, if you took a golden parachute, if you sold some stock options when you retired, if you had an inheritance and you just have a block of money and you're wondering where to get a good capital return, and you're well exposed to the growth stocks that will make you money over the next 20 years, it would be awesome to think about looking at a real estate property, commercial, residential, whatever. But if you're not in that position where you have a high discretionary amount of cash, there are other ways. Number one, you can purchase direct real estate in an IRA. You can do it. A lot of people don't know that. So let's say you have a normal IRA that you've built up over time, and you're about to retire and roll over a 401k or pension into that IRA. As a diversifier, you can purchase real estate in that IRA to be a low correlation to the rest of your portfolio. The only major rule of the road is that you have to hold that real estate IRA with a custodian that is IRS approved to hold real estate. So my wife and I actually own a small piece of the building of the registered investment advisor that I worked with, or I worked for in my hometown of Guilford. I worked with a family RIA up till 2011, and we had our own building, and each of us owned a piece of that building in our IRA, but we have to hold it at a separate custodian. And I use this company in Dallas called Equity Trust, and they just handle all of the IRS nuances of owning real estate in your IRA, but it can be done. And if you're getting great distribution yields from the rents of that of that real estate in your IRA, then it's tax sheltered until you withdraw it. And imagine if you could own real estate in a Roth account. Now that would be an interesting exercise because that's tax free, the Roth. So if I have a client who is just feeling vulnerable to what they feel is a short-term roller coaster in the equity market, which we don't believe it is, but it's hard to argue when you're looking at the results in March, April, May of this year, and wants to expand into real estate, if it can fit inside of a retirement account, it's not a bad conversation to have. Moreover, if your existing IRA is not large enough and you're still employed and you have a 401k or a pension, you can check to see if your 401k or pension has what they call in-service distributions. So you're working at IBM and you're 58, 62, and you're going to be there another 5 years, and you've got $1 million in your 401k. If you meet the criteria, you can do a tax-free rollover into a real estate approved IRA custodian in a large enough quantity to buy a property that you found, and you can make that your IRA. And then the last nuance to all of this is the old, famous, and dependable 1031 exchange privileges. So if you own other real estate, vacation home, a piece of property that was gifted to you, piece of property that you inherited when your parents passed away, just another investment property you own that is at a huge capital gain. You'd like to upgrade your real estate exposure, but you don't want to pay capital gains tax on the property you own. You can use the 1031 exchange rules to roll that property into a like property of equal or greater value, and that exchange will be tax-free. So that's another good way. And so if someone said, look, I've got, a small cottage somewhere that I bought, or condo in Florida that I bought for 180, and it's now worth 250, and I'd like to make a larger commitment to real estate, I could really use that Florida money as seed money for a more fresh real estate property, but I don't want to pay the capital gains. So you take that 250 as a 1031 exchange, combine it with another 150 of cash assets, and buy a larger, more profound, and a higher return on investment property, and you won't pay tax on the sale of that Florida condo. So hard to buy a house down the street, particularly if you live in an affluent neighborhood. Hard to buy a vacation property on Block Island or in Naples, Florida. They've all appreciated with snowbirds and pandemic, people moving, working at home. So it's making it difficult, but we do feel that real estate has a role to play in your portfolio other than your home. And so outside of these packaged publicly traded REITs, non-publicly traded REITs, opportunity zone, and interval funds, if you'd like to explore real estate, but you don't have the cash for it, using it in an IRA, pension, 401k rollover, or 1031 exchange could be the vessel that allows you to do that. So that's my presentation. Is throwing a lot at you, as we always hope to. And hopefully I didn't speed through it too quickly. So let's open it up to questions, if any. As always, we say, if you want to talk with us about real estate and how you could find something that's appropriate for you, and just schedule a time with Dave to speak with us, Steve, me, Ryan now on the team. And frankly, if you have an interest in real estate, you're just looking for more eyes to find value, we do have quite a Rolodex of realtors and people who are on the ground looking at real estate. We have a client who's a big real estate developer in Upper New England. And so we can help work our network if people are looking for real estate, either to relocate for retirement or as a second home or condo for income, whatever. Let us help if we can. But for now, thank you for your time. It's a tough period. There's some tough news on tonight. And so everybody go home and hug your kids or call them, give them a verbal hug. We appreciate you joining us for the Knowledge Series and look forward to any feedback you want to give us.